So today we're talking about the legacy gifts. And if you'd like to know more, just stay right where you are. Just watch now and learn more about the gift of gifts. And who knows, you may even decide to give the gift of gifts. Welcome to another video in our series, Financial Dream Building. And if you're new here to this channel, please remember, subscribe, turn on your notification bell so that you can be the first to be notified of our new upload. So again, we have Glen here, and he's a financial advisor as well as an infinite banking practitioner. And of course, he provides his expertise around the topic of insurance and financial education. If you'd like to know more about what we've been discussing so far, just please feel free to check out the videos in our playlist, Financial Dream Building. So Glen, can you tell me what is the gift of gifts?
Well, thank you for having me back again, Genese. So the gift of gifts, thank you. It's a little play on word for my acronym for my company, actually, right? So Gifs, as in Gifs, Griffiths Insurance Financial Services, Gifs. And this can be used as a guaranteed intergenerational financial system, which we will get into shortly. That's a mouthful, but again, just a little play on words, but it seems to stick more in the minds of people when we do it that way, okay? So let me share my screen here and get into this. Okay, just bear with me here. And let's do this. Let it show. Okay. So there, my company, Griffiths Insurance Financial Services, GIFS. And you see that strong handshake below the surface. It's all that stuff that happens in the background, right? The strong insurance that is there to provide generations of benefits, just like most trees do. All right, so gifts of legacy, right? At this time of year, we find that many parents and grandparents are thinking, what do I get these kids? They got enough toys, they don't want clothes, and especially from the grandparents' perspective, right? Because most of the fun stuff's gonna fall on the parents. But the grandparent has been around for a while and is generally thinking, you know what? I want to do something impactful, right? I wanna do something to enhance my legacy, not just from my point of view, but for what I leave behind. So there's different thoughts. They go, okay, should I just leave my grandchildren cash? And hey, you know what? Any gift is a plus. Okay. Should I pay for RESP? Well, you could, but there's generally limits to that. And depending on the funds and the significance of the funds that the grandparents might want to leave, you know what? That may just not be as much room, because you have only a certain amount of room until you are putting in too much to get the government grants. So it's not going to be as efficient. So what else? Could they buy a rental property during the position? They probably could, but if you've got a younger grandchild and you're getting a little bit up there, you may not want that and all the extra work of managing it, right? Again, for some, that would be fine, but for others, they would like to do something without having all the extra work. They don't want to do any extra work right now, right? So the solution, I call it gap gifts. And this, again, a little play on words, grandparent and parent generational income facilitator system. It's a fancy way of saying properly structured life insurance, okay? So here's how that works, okay? The grandparent, parent, godparent, aunt, uncle could do this. They own the policy and they pay for it. They can pay for 10 years, 20 years, or for the child's lifetime, they can arrange to have that happen. That is going to depend on the situation and that's how they want to set it up, but that's something that's fluid that we talk about. Now, it's possible to put the parents as contingent owners for when the grandparent passes, right? Or depending on the age and responsibility, they can make the grandchild the owner of the policy and skip the parents' generation altogether. Everybody's situation is different, so that's where we have a chat and figure out what makes the most sense, right? So here's what we don't want. We don't want things going wrong, because if things go wrong and the child passes early, the death benefit is paid out. Nobody wants that. No parent or grandparent really wants that, but it is a reality of life that unfortunately happens. However, if things go as expected, we now have an asset that could benefit the grandchildren's children, and grandchildren. Now, let me back up and say that again. It benefit the grandchildren's children and their grandchildren up to 4 generations ahead or more. Let that sink in for a moment. Does that really fall under legacy? I would say so, right? Mm-hmm. So with these, here's certain things, because we like these words, and especially the older we get, the more we like them. Guaranteed. You got guaranteed costs. You know exactly what this thing is going to cost. There's no surprises. There's guaranteed death benefits, which we'd say is a minimum starting point. There's guaranteed cash values, which again, we'll say is a minimum starting point. There's guaranteed automatic premium loans if needed. Life happens. Maybe things are a little tight. Cash is tough. Do you pay into this for a few years and then just lose it? Well, not if it's set up properly. It's going to use the cash to take care of itself if situations like that arise, right? Guaranteed access to cash values. Maybe you socked away quite a bit of money in these and hey, you need access to some money. The intent could be to put it back or not. But if you need access to money, you being the owner, the person who sets it up, have the control, and you can have access to that without stopping the program. Huge plus. And of course, as we get a little bit older, tax sheltered growth becomes more and more important because we live in a great country. We pay lots of tax. We don't mind paying our fair share, but we don't want to pay a whole lot more than that, right? So again, the access to cash value and the access to the policy can still keep growing and enforce. So I like to kind of give this analogy. It's like if you've got this rental property that you've had for say 20 years, you built up a bunch of equity. Now, whether it's an opportunity or something went wrong, but let's stay positive. Let's say another opportunity comes up, whether for another property or for a business. If you've got all this equity in there, would you sell the house if it's still cash flowing? Or would it make more sense to tap the equity, access some of that equity? Well, in most people's cases, especially those thinking legacy, they're going to access the equity. Well, it's the same thing. I shouldn't say same thing. It's similar with the policy. You know why it's not the same thing? Accessing the cash in the policy is easier because it's guaranteed that the owner can access up to 90% of the cash value, no questions asked. Okay. Way easier. And then these have been built up by contributions and dividends. So yes, you can withdraw directly, not as efficient, but you can. You can get via policy loans, which is what I'm talking about primarily, or you can access it through collateral loans. Once a dividend is declared, it cannot be taken away or reduced by down markets. And we're gonna chat a little bit more about dividends in the coming slides. So here's an example I use, okay? A couple of these are set up. Grandparents saying, you know what? I want to commit $200 a month per grandchild, but let's just talk about one in this case. $200 a month for a 5-year-old buys an initial coverage of $140,606 of permanent insurance. Now notice I said initial, because the way this is structured, this thing is going to keep on growing. Indexed, basically. And I shouldn't use the word index because it's going to keep on growing. I don't want to mix it up with other products. But in 20 years of this contribution, we're looking at possible cash value of $56,435. So think about this. There's going to be more in there than was put in. Possible death benefit, look at that. Went from 140 to around 400,000. Now let me ask you, at age 25, this person, this grandchild might be having their own children soon, or maybe not yet. Do you think that's a good legacy for the next generation, even at age 25? That's a fantastic start. Let's fast forward a little more. In 40 years, when this grandchild is 45, the cash value should be around 217,000 with a possible death benefit of 740,000. Does that spell legacy? If this person were to pass away at 45, when they have children, would $740,000 go a long way toward helping those children? Definitely. Well, let's say, what about age 65? The cash value could be about 631,000, possible death benefit of 1.16 million. At this point, they probably have grandchildren. Could 1.16 million positively affect their children and grandchildren? Definitely. And at life expectancy for most males, we're talking 85 age, cash value could be about 1.5 million, the death benefit of 1.18 million. For $200 a month, huge, huge generational, long-lasting impact, right? But don't just get caught up in the death benefit. The reason I highlighted cash values is very specific. Let's say going back to age 40 there, or year 40, at age 45, having 217,000, let's say this child dies, you know what? I want to go buy a property. They could access 150, 180,000 easily for a down payment. Think about the impact of that. You still have the asset, but now you've been able to use the asset to go and fund something else that would be another asset. There are many, many possible good ripples that can happen from this one asset, as long as you've got it and you keep it in place, that we're not even going to be able to measure on this sheet. This is just if you let it sit there and do nothing. Could they buy into a business? Could they start a business? Definitely. The cash is there. The access is there for the owner to use however they want. So again, is this a great legacy gift that could affect the next four generations or so? Definitely. As I mentioned, cash can be accessed through either direct withdrawal, policy loan, or collateralized bank loan. Your credit and debt ratios have no bearing on your access to cash. If you're a business owner, I've ever been a business owner, where your accountant tries to help you to write down as much of your expenses as possible to have as low an income as possible, but you try to go do something like qualify for a car loan or a mortgage, you find out that that's kind of a double-edged sword, right? You got lower income because you've done the right things with your accounting, but now you don't have enough to qualify for the things you need to expand your life and business. But when you need cash out of a policy, nobody's asking you for any of that. Not your debt ratio, not your credit bureau. You have cash, you have access. It's that simple. And the cash can be used for whatever it wants, for whatever you want. Nobody's going to question you, why do you need the cash? You want to buy rental property? Do that. You want to educate yourself or children or grandchildren? Do that. You want to enhance your retirement? Oh, we can do some fun things there and make sure we minimize tax. Is there a health issue? Use it for that. Totally up to the control of the owner at the time. Is that impactful, positive legacy? I would definitely say so, right? So I deal with a few different companies. I didn't put the names there, but I put this there. Company E, it's credited dividends for every year over 80 years. This is the baby of the group, right? Regardless of markets, over 80 years. Company C, over 170 years. You guys think about that. Consistently paying out to make sure these numbers are possible. Company F, teenager, over 100 years. Company S, over 140 years of dividends, regardless of markets, depressions, recessions, you name it. Do you notice a trend forming there? Positive, continuous growth in a steady environment that's not subject to stock market fluctuations gives you numbers like I showed you earlier because of consistency and time. That, my friends, is the end of the slideshow. I probably got a few questions in your minds, but at the end of the day, it comes back to this. We all want to leave a legacy, right? And at this time of year, people are thinking about gifts. If you can combine the two and not necessarily give the grandkids something they'll jump up and down about because they're not going to, but at least not now. You give them some time, they'll be very thankful for you setting up something like this for them. And this is not just for the grandkids. These can be applied for yourselves, whether you're age 20 or age 80, right? We can set something up like this, but I just wanted to give an idea, especially this time of year when people are thinking about giving gifts, and especially the grandparents are thinking about giving meaningful, lasting gifts. Right. Not necessarily the stuff that we can go show everybody and go, hey, look what I got. These are being set up every single day, and I help parents and grandparents do this all the time. And again, remember this, you're in control. So if something happens, whether that's emergency or a great opportunity comes up, your money's not locked in jail. You can have access to up to 90% of that funds, no questions asked, and keep the program going. It doesn't have to be an either or, it's an and. All right, so for more information, I would love to have a chat with you one-on-one, but I just wanted to let you guys know that these are out there. These are fantastic. They're predictable. Could be boring, but we're not gonna have a minus 30 ever, because that's just not how these are. All right, but for more information, again, let's have a chat one-on-one, because we can help you give the gift of gifts that will last for generation.
I love it. And I like in the scenarios how you did age 20, age 40, age 65, age 85. So then, you know, people feel included, right? So whatever age group you're in, you're going to feel included. So, you know, say if they have that $200 that they can invest each month, then they can actually just give that gift of gifts. I mean, it's just fabulous. It's a really good gift to give. And it's the earnings is just amazing in terms of the guarantees that they get and the tax shelter. As I say, it's all about tax shelter, right? Here, I mean,
it is, and accessing money in a great environment. Money that, again, like I said, you don't have to. It's not like I have to cash out to go do something else. I can access these funds just like I mentioned. People do with a rental property. You know, you can tap some of the equity to go buy another rental property. Well, you can do that here, but you don't have to go qualify. Huge, huge advantage.
All right. Well, thank you so much, Glenn. I mean, really great topic. And I mean, you came up with a gift at a really good time. So, I mean, people are looking for gifts now. So at least now you've opened up their options, right? Definitely. So now, I mean, I'd like to hear more from you all. I mean, leave in the comments below. For those of you found this really interesting and actually you're now considering giving the gift of gifts, I'd love to know which one of you are planning to do that. So leave in the comments below so that we can know. And our contact information is there. So feel free to contact us as well. Leave your comments. Give a thumbs up if you love the information that you get. It is valuable information for you. And remember to subscribe. And that's all for this week. And then we'll see you again in our next video. All right. So thanks for watching.
Thank you guys. Have a great weekend.
Bye.
Bye-bye.